There we go. Hey everybody, welcome back. So this is my Chapter 7 video. As you hopefully know by now, Chapter 7 is about measuring total output and total income. So total output is literally the total output of an economy, all the goods and services that an economy produces. And total income is just kind of the flip side, all the income earned by the various people in an economy. So sort of the two major overall macroeconomic measures of the size of an economy. So the primary way that economists measure total output is through GDP, gross domestic product, and we've talked about this a bit in chapter 5, I think it was, but the formula's on the screen there. GDP equals C plus I plus G plus XN, where those variables are defined as below. So again, I think we discussed this, but let me just go through a couple of key things about each of those. C stands for personal consumption. So it's purchases by households of final goods and services. Again, we talked about this before, but remember that the final goods and services means we're only counting those final goods themselves, not the intermediate goods along the way. So, for example, if a carpenter buys a bunch of lumber and then builds a deck on someone's house, the price of the lumber doesn't contribute to GDP except in that it's included in the final price of the deck. So the deck would be the final good and service. That price gets put into GDP, not the purchase of the lumber. I is private investment. So it's easy to be confused on this one. Don't think like we normally think of investment. If you buy stocks or you put some money in your 401k, that is not the kind of investment we're talking about. Investment means, really, it means that a business somewhere is investing in capital durable goods. So businesses buying capital goods like machinery or buildings or equipment. Construction of new housing is considered an investment, which it is. I mean, you're basically a business owner if you own a house. And inventory changes in businesses. Those show us whether businesses are building up inventory and kind of investing in the future because they expect more sales in the future, or if they don't, they kind of let their inventory dwindle. So that component can be positive or negative. G stands for government purchases. That's an important term. It's not government spending. It's not all government spending. So it's literally the purchases by the government of final goods and services. So what doesn't count there would be transfer payments and things like that. So transfer payments aren't a purchase because those are things like Social Security, welfare, or pensions of government employees. Those don't really represent a purchase of anything. That's the government transferring money to someone else who will then take that money and spend it. So when those people spend their money, it's going to show up in C. So that's how it gets included in GDP, but it's not an actual government purchase. When the government gives Social Security benefits or welfare benefits, they're not purchasing anything. They're just transferring money. So what would count would be government purchases of goods themselves. So if they buy tanks or planes for the military, or they build a new school building, something like that, or services such as the salary of government employees like myself, or when the government hires consulting firms or someone to do something like that. So those things count, but not transfer payments. And then last, XN is net exports. So it's exports minus imports. That's because when we export goods, we sell them overseas, the money comes into our country. So we count that as our GDP. When we import goods, we bring goods in, but our money goes out. So that gets treated as a negative in our GDP. It gets subtracted out. So that's how we calculate GDP in the most common way. You've seen this slide too. I won't go through it all, but this is that circular flow, which shows both the flow of physical goods, factors of production and actual goods and services, and the flow of money between firms and household. And this is kind of our big theoretical conceptual model of how an economy overall functions. So when we talk about measuring GDP, total output, total income, basically we're just measuring the size of this circular flow. So it's another way of just saying, we're measuring the size of the overall economy. But just wanted to remind you of that image. That might be helpful. I think this is not in the book, but just to give you some sense of the different components. Maybe this is from the book. I can't remember. But here are the components of GDP for the U.S. currently, or this is within a year or two. Our total GDP is around 19 or 20 trillion. over half of that is consumption. The next biggest component is government, followed by investment, and net exports in recent years have been negative, meaning we're importing more than we export. A lot of people have made a big deal about that. That's big talk in our political world, and it is probably something to be concerned about. But notice how small that component is relative to everything else. It's maybe not as big a deal as we make of it sometimes, in my opinion. Anyway, another concept is value added. Um, this is closely related, but take the example here of live Maine lobster. A fisherman goes out on the coast of Maine, catches live Maine lobster, and let's say they sell them to a company like Maine Shellfish for $5,000. The fisherman obviously has expenses incurred along the way, but we're going to sort of ignore those and just assume it's pure profit. So the fisherman has created or added $5,000 worth of value to the economy. Following along the next row, let's say Maine Shellfish takes that live lobster and pays people to pick out the lobster meat and package it up so it's ready to sell. They sell it to a seafood restaurant in Florida for a price of $8,000. So you can see that they have added $3,000 worth of value. They bought something for $5,000, sold it for $8,000, so they've added $3,000 worth of value. So it's kind of like profit. Next row, the seafood restaurant in Florida takes that $8,000 worth of picked lobster meat, turns it into fancy Maine lobster tail dinners, sells it to tourists for a total of $15,000. So they have added another $7,000 worth of value. So if you were to add those three numbers up, the value added 5,000 plus 3,000 plus 7,000, you get 15,000. So that's the total amount of value added or value created throughout this process. And interestingly, if you think about the way we calculated GDP, the live Maine lobster and the picked lobster meat are intermediate goods. Those would not count in GDP. What counts in GDP is the final good or service, which would be the $15,000 worth of meals served at a restaurant. So GDP looks at final goods and services. Value added just sort of looks at the value created or added each step along the way. But in theory, they should give us the same thing. So I guess I bring it up here because value added is kind of an important concept. You hear it talked about a lot in economic development circles, especially here in Maine. People who are talking about what can we do to improve the Maine economy. It's often brought up that we produce a lot of timber. We produce a lot of blueberries and potatoes. And the truth is we export most of that and someone else adds value and does something with it. So one of the big discussions in economic development circles, especially in Maine, is why don't we add more value to the things that we already produce? So instead of exporting those goods, let's make something out of them, make a higher value product that'll create more profit, more GDP, more jobs. So just kind of a side note there. So we've mostly talked about GDP here. You've probably also heard at different times of GNP, gross national product. They're very, very similar. They're kind of essentially measuring the same thing, but there's a bit of a difference. GDP, if you recall the full definition, talked about the dollar value of all final goods and services produced in a country within a given year. So it literally has to be produced in the country. It doesn't matter who makes it, but if it's produced in a country, it counts in that country's GDP. GNP is the value of all final goods and services produced by a country's residents or their factors of production in a given year. So an American worker working abroad might produce something in another country, but because it was produced by an American resident, it contributes to our GDP. So they're very fine differences. Anyway, look at the example below. Assume a resident of Madawaska, Maine works at a paper mill in New Brunswick, earning a salary of $55,000. Whose GDP does that increase? Well, it's produced in Canada, so that's going to be Canada's. Whose GNP? Well, it's earned by an American resident, so it counts for America's GNP. So that's the difference. I think I'm out of time, so I'm going to stop it there and continue later. Thanks.